Good morning, everyone, and welcome to another episode of Daily Rates Live with the Mortgage Calculator. We are a broker licensed in over 30 with over 300 loan officers that would be happy to assist for any type of loan program that we'll go over. And we specialize in some of the options. Today, we're going to look at a few different options in detail for a fixed rate arm. So adjustable is definitely a popular topic, especially as the rates change and fluctuate. So definitely a good consider is to compare them directly side by side. Be able to compare some conventional options as well as some of our non-QM options. Now that we are live on all the platforms, let me go ahead and get started. So what we like to do every day is first off, just check out the general market conditions. So let me switch my screen. And we'll take a peek at the 10-year Treasury to give us an idea of where rates are in general. So as I said, this is the 10-year Treasury, definitely one of the best indicators for rates overall. So we look at a wide variety of different programs when we're looking at our live rate show here. So you can see in the last 5 days, definitely a little bit of an increase. It has to go a little bit up and down. I want to pull this out a little longer to put everything into perspective. And as you can see here, we're definitely still at 1-year lows. So definitely a good thing for all of our customers out there. Let me scroll up a little bit, sorry. That are looking to be shopping. We're still at 1 lows, and the weekly fluctuations do not really affect the rates that much. So let's actually check out our rates for today for our standard programs. And again, if you'd like a full loan estimate, please get with one of our team members and send you a full breakdown. So for this scenario, what we have here on our automated engine here is a basic setup, so we can compare all the different loan options. So we have a single family home here, $500,000 purchase price, $300,000 loan amount. That corresponds to 60%. We use an estimated 760 FICO, debt to income. That way we can compare all the programs for the exact same scenario. So here, first off, we have conventional option, typically what most people mortgage. Conventional comes in today, 5.875 rate, final APR 6.135. For our borrowers that may not qualify for conventional, we typically do an FHA option. FHA allows more leniency on credit issues, as well as a higher overall debt to income ratio, but does require upfront in-year insurance. And FHA comes in at 5.25 rate, but with the additional costs there, mortgage insurance and everything, you always want to look at the APR. APR coming in at 6.16, so a little bit higher than conventional, which is for an FHA option. Now, for our borrowers that qualify for VA, our active military, veterans, houses, if you qualify for VA, these programs are today 5.375 rate, but definitely less fees included for our vets here. Final APR 6.339, so beats both FHA and conventional, which is typical for our VA options. So definitely take a look at VA if you do qualify. And our top week, we went over our USDA options in a USDA eligible area, which you have to look up, but definitely a great option for those properties and those borrowers that are USDA coming in today, 5.1, 5.802 with all of the fees included. So we typically compare that to an FHA option or a conventional option. Borrowers shopping in those USDA areas, country. And once things start to get interesting here, we love to present our non-QM program. So we have hundreds of different non-QM options here. This is our non-QM alt doc for a primary home. So we can use alt docs. That is things like payments, 1099s, P&Ls, all kinds of different income options if our customer doesn't qualify using conventional options here. And the rates are almost identical, 5.87, almost the same as conventional. Final APR coming in at 5, just a touch higher for our non-QM alt doc options. So great options for our self-employed borrowers in particular. And we can use alt docs for investment properties coming in today at 6% rate, final APR 6.321, which will compare to our conforming conventional options for coming in at 6% rate as well, final APR 6.311, so just a touch cheaper on the cost. And we love our DSCR, our favorite non-QM options here. No income or use the estimated rents from the property to determine a DSCR ratio, stands for debt service coverage ratio. If the expense That's a ratio of 1.0, which is what we use for these examples. And the first example here, standard 3-year prepayment penalty. Pretty typical for these type options. Rates come in today at final APR 6.308. So just actually a touch lower than conventional, which is pretty DSCR to be conventional. And we can add a get the rates down to 5.875, final APR 6.181. Definitely cheaper than conventional. Absolutely amazing. Here, all kinds of different programs, but we'll save those all for a different day. Let's get into our example today, because a lot of our clients see our fixed rate options here, which are pretty standard here up on the website, but we obviously have adjustable options as well. And the rates are changing and high like they are right now, a popular question. So we will compare an exact example here for this exact. I just went into my local area here. This is an exact home here for sale for 1.175 million. Homes are definitely expensive. Use this as a good example because we're going to compare conventional and non-QM and do an example of fixed versus adjustable for each of them. Allows us to compare why conventional we can't go up to the same loan amounts. So a great option here. Prices are pretty high here in the Fort Lauderdale area. Home our borrower wanted to purchase. Very often they would say, do you have fixed and adjustable? Can we check them both out? So this is our borrower here that we're going to use for this exact scenario. So first up, because typically our borrower the least amount down, the first here was our non-QM option, which allows us to exceed the maximum loan amount of conventional, which you will see here in a minute is restrictive. So our non-QM option allows us to put 10% down for a primary home purchase. In this example, our borrower in this example, just like the 760 FICO, but this is a full doc non-QM, also known as a jumbo loan. We do have some, in particular, prime jumbo, but that's not today's episode. So this is a typical non-QM full doc, and we're going to be able to put 10% down with no PMI because it does not have PMI required. So this is a great option. Lowest rate option 7.125 for 2.25 discount points and cost here, and we even have a rate option, no cost option for a 7.5 rate. And you'll see here we're able to put 10% down and get over $1 million loan in this, which is a typical request our borrowers want to put them on their new home purchase. You can see here all the different options that we select. You can see the LTV and the FICO score we use for this. Now, what we always want to compare is this with a standard non-QM adjustable rate. So when we compare the rates here, notice we have these rate options, and we'll have some different rate options, but this is a very similar program, our non-full doc option, and it's using a 5/6 ARM, so 5 years fixed and then adjust every 6 months based on the SOFR rate there. And this requires a 10% down payment, no PMI, just like the other option. And here you see we have slightly lower rates. We can get down to a 7% rate for 2.375 points in cost. And we do have a par rate at 5. So again, if we'll compare that to our fixed rate option, just a touch lower. There's not that much difference. Very often when I'm advising my clients to compare these two options, fixed is definitely more predictable and definitely, in my opinion, to just go down a touch in rate for very similar cost structure. But now let's compare options. So when we ask our borrowers to go conventional, stay conforming under the conforming limits, that kind of puts us in a little bit of a bind here because the property is very high price. So fortunately, the limits here are going to be the limits, the loan limits, $832,750 limit area, and that's going to require us, unfortunately, to do a conforming conventional loan. We're 30% down. So our borrower payment, they're going to be pretty bummed down in this example. We do have a couple hacks, the topics of some of our other shows, to add a HELOC and do a combo, but that's not today's topic. So we're just comparing fixed versus adjustable, the base mortgage either way that has to stay conforming. This is our fixed. And we We do have some great rates, low as 5.625 in this scenario for 2.125 discount points and costs. And we even have options with lender credits, so 6.49 rate, a little bit of a lender credit towards our closing costs. You see here with this demo, much lower payment, but that's because we're only financing $822,000 under the limits there. $352,000 down payment. And again, here we have the same setup. It was 70% over, and we're using the same 765. Now, to compare that to our adjustable rates for conventional, we will choose our standard conforming 5/6 SOFR arm. So the same setup there, 5-year fixed, 6-year adjust rate. And we're going to put 30% down because stay under the limits. And you see the rates, 0.25 rate is the lowest option. And we don't have a par or lender credit option because this is kind of a weak scenario here. So 5.625 rate at 1.625 in cost. But this was definitely the lowest rate option. So this affords a little bit of a difference. So our borrowers staying in the conventional loan limit area do see a little bit of a difference here. The lowest rate option, again, 5.25. Lowest rate option for fixed, 5.625. So in this scenario, if our client can afford the 30% down and is comparing these two options side by side, you can see that doing the ARM, if they're up for the additional comes to having the payment change in 5 years, perhaps, could go up, could go down. You don't exactly know right now, right? We don't have a crystal ball. A little bit more, but there is quite a bit of difference here. So again, 2.125 cost for 5.625 as the lowest rate option we can buy it down to when we're going fixed. And to do the adjustable, we can 5.25 rate for very similar cost there, 2.375 discount points in cost. So can get the rate down a little bit with ARMs in the conventional realm. But remember, with non-QM, there is not that much of a difference when we're going to use a jumbo, the other non-QM program. So very common request from our borrowers. Hopefully that's helpful for our borrowers out there that are out there shopping and asking the same question right now. Hopefully that puts some of that to bed. And for our team members watching there, definitely a common question. Hopefully this gives them some more answers to provide their clients. So if you need an estimate, a full breakdown of exactly what your scenario is for a fixed rate or ARM, please get with our team members, drop a comment, go to our website. We have over 300 loan officers in over 30 states. We'd be happy to help you out. So thanks everybody for joining us today, and we'll be back later this week with another episode of